couple of questions, one of which is actually something that has been asked before as to what type of strategies you can expect in options, and it's just the same answer that the common strategies that you have discussed in other classes, and any option strategy is basically a variation on two things. One is time to expiry, and the other is basically the exercise price and the number of options. The more options you include, the better is the risk management, but lower is the potential risk and return also. So that's why I think that it is best for us to keep to two options. And then, if there is a question with respect to, okay, if you think that, for example, if you take a long straddle, then if the stock price doesn't move, then you are going to lose on both sides. What is it that you can do to at least minimize the loss a little bit? That's when you combine the exercise prices and all, and you flatten out the curve a little bit so that you don't lose as much. So other than that, I mean, all option strategies, and one can also always think in terms of its own strategy. For example, the collar strategy and all that, those are clearly for risk management. So most of the time, option strategies can be either for risk management or maximize your return. For example, straddle is definitely not a risk, minimization of risk. It's maximization of your return. So whenever you are bull, then you will choose certain types of combinations, and whenever you are bearish, you will choose certain other kinds of combinations. Most of the time, you will see that bull positions tend to be on the long side, bear positions tend to be on the short side, in the sense that on a short call or on a short put, you make the money, but then you could be exposed to significant amount of risk on either side of the stock price. So those are the general things that are, and remember that the exam actually is open book. So even if I ask you a particular combination that has not been directly discussed in class, you can always go back to your notes and refer to that and basically create the strategy on your own. So I wouldn't worry too much about it. The other question was whether stock and cash is a possibility. Definitely, there is no question about it that many transactions actually tend to be both cash and stock. But most of them right now is predominantly stock. And one of the things that I still doubt whether I will be able to actually get time is the case that I have posted, which is the stock versus cash. I would strongly urge all of you to at least read it. If I find 15 minutes or so tomorrow, I will definitely go through that. So the main agenda today is the interest rate swap. I will get to the merger case, of course. Interest rate swap, and you already have been exposed to it. There is always a little bit of confusion with respect to that. So I will spend most of the time today on that particular, or the two sets of cases. And I presented a very extensive solution to the Dominion case that I may not have time to go through, and I should allow the class to go through that. It took me a little time to prepare it because I'm using this case for the first time this year. Because as I told you that it is difficult to find the right Harvard cases because they tend to be long and complicated. So I always try to get cases that are somewhat shorter and not as complicated. This case does satisfy both of them, which is why I chose this case. So you need to be need to understand this case very, very well. And I think the long note that I have presented will be helpful to the students. Now, if I cannot get through all of it today, to allow you time, I will then take this tomorrow. And in fact, to allow you time to go through the case as well as the solution that I have presented, I may actually finish the class a little sooner today so that you have time to review my notes and come back tomorrow. And if necessary, I will add half an hour to tomorrow's class, because the case that we have tomorrow on the portfolio theory should not take that long. It's pretty straightforward, and I think you will all be very familiar with it. So I don't expect that to take that long. Maybe an hour, but which will give us more time to talk about this interest rate swap case tomorrow. So let's start with the merger case. And let's start with the, no problem hearing me now, right?
You're good.
We can hear you.
Good. So, I have to say that 3 or 4 actual merger cases that are ongoing right now that I have looked at, one of which I'm going to put on the exam, are all cash plus stock, which is why I felt that given that there has been a question, definitely I should spend a little time to actually go through this. Now, let me tell you what type of questions you can expect. Now, remember that the whole purpose of this case is really to solve for the neutral probability. That means what is the probability of success of the merger for you not to make any money? That means that if the probability, if your perception, or actually I should not say perception, this is not your perception, this is the theoretical probability that the merger will succeed based strictly on the prices after the merger has been announced. Remember that you should only work with the prices after the merger has been announced. For the expected profit, that is basically the prices that you should be using. However, the prices before the merger has been announced is also important to calculate the neutral probability, zero return probability, simply because of the assumption that you make that if the merger fails for certain reason, the acquirer and the target prices will come back to the pre-announcement level. As I mentioned to you before, that is strictly an assumption. But that's a reasonable assumption to make, but I'm sure that almost never happens. So that is the weakness of this model, which is why the formula that you are using and the probability that you will be solving for is not precise. As it happens with almost all types of models and formulas in economics and finance, they are not precise. They are not supposed to work in real life. Real life is all uncertain. So you should take this formula, as with any formula, as simply an approximation. This is the way the market is expected to behave. Now, one of the other confusion that I have noticed in the students is that as an arbitrator, do you want the neutral, and this is a question that I've asked before, which I'm not going to directly answer, but I will take the pulse of the class as to what they think. Do you want the neutral probability to be high or low? After you have solved for the neutral probability where your rate of return is 0, do you want that probability for you to be making money to be high or low?
Hi.
Does everybody agree with that? Can you explain why you expect, meaning that, let's take a look at the case. let's take a look at the case and then we will actually answer that question. So this is an example, and this may look like textbook examples, but when you actually read the case in the test, you will see that these are very similar to exactly how the case has framed it. Announces an acquisition of company A for a cash stock deal, which and offers $20 in cash for 25% of T. For the remaining 75%, T shareholders would receive 0.5 shares of A stock. Now, as I told you, there is some confusion about this thing, and this statement I have often noticed is always misleading to a few students. And that's exactly the type of question that I received, is that people think that the price is 20 for the whole 25%, or rather only 25%. That is not the way this should be read. That means what the way it should be read is that if this were a pure cash deal, then the company would pay $20. Similarly, if this were a fully stock deal, then you would actually get 0.5 shares of A. That's the way it should be read. So the actual real consideration is 25 times to 20 times 0.25. This is the first source of confusion that I have noticed in the students, that many students get this thing wrong. So it is important, because I expect that the questions will be allocated. Make sure that the person that is doing this question for the group understands this mechanism. So the offer price is, as you can see here, is 0.25 plus 20, 0.75, 75% is 0.5 times 35. Now 35 must be the post-announcement price of company A. Right here, post-announcement, A is 35 and target is 17. If you get this particular equation the right way, then you really should not be making a mistake in the case. Most of the time, I see mistake in the very first step. Do not forget that, do not make that mistake. So 18.125 is actually the offer price. Offer price given those prices. But the same, the idea here is that, of course, since there is actually a 0.25%, and also half of the A shares, realize that the first component of this, the 0.25 times 20, that is fixed. That's not going to change. So this is a negotiated deal, because the whole purpose of this is to make sure, or is to minimize the downside risk on the acquirer stock. Because you'll notice that if it is a pure fully cash deal, then there is really a stock price on expiry or the completion of the merger doesn't really matter. It is immaterial, because you are going to get cash. So on a cash deal, it doesn't matter. So this part actually is fixed. The variability is in this part right here, and the stock price of A. The main variability is right here. So 18.125 gross spread, because you buy a target stock for 17, you are going to make 1.125. Then the question is that expected profit and expected loss. So you find out what is the expected loss if the deal fails. If the deal breaks and A shares, this is the assumption right here, that if A shares trade back to 40 and T shares trade back to 15. Now, I have looked for failed mergers where these numbers are also given, but I could not find any. Because with failed mergers, you can actually see what the post-failure prices were. This is post-announcement. So here, post-failure, you don't know what the prices will be. So you expect that you are assuming that it will go back to the pre-announcement price. So after the deal breaks, 1 share of T is worth 15, you bought it, and loss on the long position is going to be 15 minus 17 minus 2, because you bought it for 17, selling it for 15, and then short a 0.5 shares of A on 75% goes back to 40. So for 35 minus 40 times 0.375, this number here is 0.75 times 0.5. So there are two factors here. Why they did not write it out, I don't know. And so the loss on transaction is 3.875, and the other number is 1.125. These are all basically transaction cost and dividend adjustments. After you do that, bottom line is 0.25 is EP, and expected loss is 4.275. That gives you 85% as the required probability, or as the probability implied in the prices, pre and post announcement prices, that for you to make any money, this deal must go through with 85% probability. And Cliff tells me there are two possible answers to this question. That as an arbitrator, I don't want this number to be as high as possible or as low as possible. 0.85 is actually pretty high because the maximum number is 1. Now, here is one question that I may ask you. That if this number is 1, that means that you are going to be making any money if the deal goes through. Otherwise, you're going to lose. That means that the only way that you will make any money is if the deal actually goes through. So Cliff said that he wants this number to be as high as possible. Only other possible answer with 50% chance to be right is no, I want as low as possible. Now, I mean, any answer you give to this, you will have to explain. So I'm going to not spend any more time on this particular thing. So probability of deal occurrence, 85% probability, and probability of deal breakup is 15%. Now, the interpretation is that 85% probability will give you 0 rate of return because that's the way this has been calculated. So do you want the number or your perceived or estimated number? These are numbers based on the market prices. And also these are numbers that actually assume that the deal may fail, and assumes that if the deal fails, then it will come back to the original prices. Your estimated probability can be different because you may have information that allows you to make adjustments on these numbers. Remember, the only adjustments that you can make are actually in the post-announcement prices, nothing else. So in any case, and of course, the post-announcement prices or post-failure prices actually will depend on whether any other reasons for the failure than what seems apparent. What is the underlying reason for the failure? Realize that here is how the assumption that it will come back to the pre-announcement price can be violated, because pre-announcement price was based on certain assumptions. And you will see that in the Abbott versus Alza case, there is actually a federal case going on. And if the question is, what will happen to the merger if, I can tell you right now that because I want my exams to be as transparent as possible. I don't believe in surprising the students. Those of you that have taken classes with me know that it will be case oriented, and I will pretty much tell you what to expect so that you can prepare for it. Now, one of the things that you can expect in this particular case, now obviously the case is completely solved, is I will actually give you a post or a sequel to this case, meaning that there is actually some information that I can obtain as to what happened on this case. But the real question is in the last paragraph. And I think the students should think about that any time you are actually, because these are the questions that come up, that because one of the things that you cannot change is the constant fluctuation in the acquirer and target prices. So calculation of the probability, I think, is mechanical. Everybody will be able to do that, I'm sure. But that's not the basic essence of the case at all. The basic essence of the case is to realize that prices are constantly fluctuating. And there are a series of prices that are given for a series of dates where they have actually told you what the prices are. The question is that do you understand the enormous amount of risk that is involved in this strategy because the spread is continuously changing? The spread is actually the arbitrage profit that you are trying to make. And remember, in the last paragraph, they are saying that the spread has actually gone up. And there are three choices that he has. One, don't do anything. Two, close the position and take the loss and run. And three is stay in the position. Now, of course, if he stays in the position, then there is actually an expectation that the loss might be reversed. And remember that his main problem is the downside risk on A. That the whole problem in this particular stock for stock merger is the downside risk on the acquirer stock. And it's very clear that you can hedge some of it by buying a put option. But put options are costly. That's what he's talking about. That I can definitely hedge. But if I buy a put option, a large chunk of my return is already gone. So this is a very tricky situation for him. And I will urge the students to pay more attention to the last paragraph than any other part of the case, because the most other parts have already been solved for you. There is nothing else to do. And of course, now one of the other things that you can do, which should be pretty straightforward, is calculate this probability, which has not been done for the case. That you can do and find out as to what is the probability, the minimum probability for the deal to go through, so that you don't make money. That's the neutral probability. That has not been done. So the way to study this case would be to analyze the risk that he's facing because of the fluctuation in the spread, and what should he do, and of course the equilibrium probability for no return. Any question?
The only question I had at the end where they talked about doubling down. How much was he going to have to double down to? What was he going to try to double down to? I didn't see an endpoint there.
Well, that's a very good question, because remember, he started off with only half of the position that they actually invest.
Yeah, 12.5 million.
Exactly. So that I cannot answer, because there is nothing in the case that tells me as to how to precisely answer. However, there is room for him to actually double down. That's the whole point, which is why he's considering that. That should I, because if he had invested all the money, of course, if he had invested all of the money, then the extent of loss that he would suffer would be much higher.
So I could use the 25 million as like an upper limit for the double down. Okay.
Sure. That would definitely be a plausible answer to the choice that should I, increase my investment in the position? Yes.
Because if you looked at the two stocks with the interest rate they were going to pay for his 5% on the money he made versus the 6% versus the margin, he's down about $250,000.
Yeah.
When it's time to make the decision.
Yes.
So I guess there is room to double down or just buy yourself out at that point.
Mm-hmm.
But
so, folks, before I start the interest rate swap, are there any other questions on this case or any other previous things that I have discussed? Of course, you will have time tomorrow to ask me questions. You will also have time on June 3 to ask me questions. I expect that by June 3, the students will have looked at the material in more detail. So I'm going to start interest rate swap now. And there are two cases. The first one I don't think is complicated at all. But before I get into that, and of course, remember that I have already posted my own notes, which took me quite a bit of time to prepare. But I did not actually have slides because this particular case, the first one, is very, very well written and very short. So I don't see any point. I didn't see any point to actually duplicate that effort. So I'm going to actually start by looking at this case, which is the interest rate swaps case. And start with the fundamental. Now, before we get to the reading the case in more detail, explain to me what is an interest rate swap. That and why is it that people use that?
Essentially, interest rate swap is you're swapping cash flows depending on which way you go. You're either going to get a fixed rate or you're going to get a floating rate. And so what he wanted a fixed rate to essentially fix his costs, and he wanted to know what his payments were going to be. And somebody was willing to bet against that they would make more money with the floating rate.
So basically, what's going on here is that you have either a long or a short position, doesn't matter, in some fixed income instrument where you are either paying or receiving fixed rate or floating rate, and you want to switch from fixed to floating and floating to fixed. The incentives of that are not really explained in that. As to why you'll be interested in that has not been explained. So, one possible scenario where you think that yes, this is the type of question that you might really think about. That who is likely to be interested in switching from a fixed to a floating payment, and the reverse also. Now, from a risk management perspective, you can immediately tell that obviously a fixed rate is less risky, no doubt about it. And anything that has no fluctuation is by definition less risky. So from a risk management perspective, you would wonder, why am I actually going to be switching from a fixed to a floating? Now, this is a question for the class, and Alex, you have really monopolized most of the questions, so I'm going to expect somebody else to think about this question and answer me. That from a risk management perspective, there is no doubt that a fixed rate, pay or receive, no matter, is the least risky option that you may have. Why would you want to go from a fixed to a floating rate? Why would you switch that? I mean, what I'm asking
I can give it a shot, Professor. It's depending on your expectations. If you know the interest rates will rise, for example, or fall, so you can build your strategy accordingly, because they're not going to stay stable. Well, long term, especially if you're doing like a 30-year or basically like a 3-year or a 10-year, like in that example that we had.
Mm-hmm. Okay. Well, I mean, one way of looking at it is that, of course, mortgage, the homeowners do not really do swaps. But as you know, that if you feel that the interest rate is high, current mortgage rate, then you might actually consider floating rate. It's the same type of scenario, that it depends on two things. One is that, of course, risk management is a top concern. But on the other hand, it may so happen that the fixed rate is possibly a little high. So you want to switch to a floating rate. Floating rate, if the rates drop, then you will get the advantage of that. And of course, the converse is also true, that if you are in a floating rate and you don't want it, you can switch to a fixed rate. Now, one of the basic things that you have to remember in the pricing of interest rate swaps is that it is a zero-sum game, in the sense that neither party, by definition, that the swap rate will be such that neither party makes any money. In real life, that is not true. But at the initiation of the option, or rather the swap, it will be priced such that it is actually not profitable to either side. Now, I just said option, but there is something called a swaption. Has Yakov talked about a swaption?
Yes.
Okay. So you already know that a swaption is an option on the swap. I mean, it's basically works just like anything else, that when it is something that you can decide to take if you see that interest rate movements are actually beginning to look favorable given the characteristics of the option. So there is no real reason to actually talk about it. If you just apply the same principles as you do to the stock option, then there is really nothing more to it than to realize that, okay, here is the swap rate right now, doesn't look very attractive to me, let me take a swaption. That's all it is. So I'm not going to go into that, but I'm going to remain with the swaps. So let's take a look at the definition. So it says swaps are financial contracts between two parties to exchange cash flow, typically in the form of an exchange between fixed rate payments, which are the same through the life of the contract, for floating rate payments, which change every period over a set period of time. These agreements enable entities to manage their interest rate exposure, clearly a risk management strategy. Effectively, for instance, a company financing itself with a fixed rate loan might enter into a IRS. IRS is interest rate swap, to convert to its fixed payments into floating rate payments, betting on decreasing interest rates. As I said, you could do that with mortgages, that you expect that, yes, interest rates will drop, so you stay with the floating rate rather than the fixed rate. So then conversely, a financial institution holding floating rate assets might seek to hedge against potential decreases because they are receiving. So then they don't want to receive less if interest rates drop, by entering into a swap to receive fixed payments. Companies enter the IRS to hedge against interest rate movements, to speculate on future interest rate movements, or to lock in. The pricing of IRS is based on the concept that the net present value, which considers the difference between the present value of fixed rate cash flows and the present value of the floating rate cash flows, this calculations relies on several key factors, including the notional amount and all that. I don't really need to read all of this. Let us go to the example. So here is on that date, January 1, 2020, no cash exchange. So at the initiation, there is no the exchanging of cash. The two parties agree on the IRS spread. This is the most important term, IRS spread. Now, I should point out that anytime you talk about spread in financial instruments, you think in terms of difference of two rates. This is not quite what that is. So this is mainly a technical jargon that applies in a unique way to IRS. That is something that you need to keep in mind. IRS spread that the fixed payer will pay every 6 months, and the notional value of the contract. So here is an example. The fixed payer pays IRS spread. Notice that the IRS spread is actually the fixed rate. That's why this is so important. Over half the notional contract, because these are payments every 6 months, of course, the floater payer pays 6-month rate that was observed on January 2020 over the same amount. on that date, the parties observe the current 6-month rate, which will be the base for payment occurring 6 months later. So this particular example is very easy to follow. This actually shows the 6 payments that will be made. All of the payments are actually the same, but important thing is that this is the floating part. The one at the top is the floating part. One at the bottom is the fixed part. So the IRS spread basically means the fixed rate of interest. That's what it means here. And notice that all of the entries are exactly the same. So let's look at an example. Here is the question. How do the parties determine the IRS spread? This is the most important question in both cases. And this is definitely going to be a question mechanically, so that you understand the mechanics of the swap. This is definitely going to be a question in the test. That I will definitely give you data. I'll try to give you actual data to the extent possible. And I'll ask you to, price the swap. And basically, when I say price the swap, I'm asking you to tell me what is the IRS spread. And you will see that if you understand the examples here, and I have another example from the second case for which I have already posted the spreadsheet that is quite clear. I mean, you should be able to follow that. So IRS spread to exchange over the life of the contract. As swaps do not involve cash exchanges at the initiation of the contract, the IRS spread is set so that the present value of the payments received by the two sides is the same. So this is by definition a rate of fixed rate such that at initiation neither party profits. However, remember, one of the parties will definitely profit depending on how interest rates actually. You'll see an example here. So here is the 4 periods. Here are the spot rates, okay? And here are the forward rates. There is going to be some formula involved in the relationship between spot and forward rates. For that, those of you that do not understand the relationship between spot and forward rates, I have actually posted one of my notes, and let me just show that to you. So that's this one. Can everybody see that?
Yes.
We can see.
At least I think it's posted if I did not miss it. So S1 is the 1-year spot rate today. S1 is a 1-year spot rate. F2 is the 1-year forward rate, starting 1 year from today. That's why it is called F2. Now, both are observable today. Or I can actually, usually what happens is that S1 and S2 are observable. We want to derive 2-year spot rate. That means S2 is what we want to derive. Difference between S1 and S2 is both are spot. By definition, spot rate means today. Okay, and both are definitely you can see both of them. Now, if this is the case, because the question is, how does market come up with S2? Because it doesn't know what will be the rate 1 year from today. So what must happen is this formula that S1 is for 4%, invest today at 1 year. I'm not going to go through the mechanics of it all. You will see that this relationship will hold. That if you invest for 2 years at the spot rate, you will get 1 plus S2 squared. Remember, all rates are annualized, which is why I have squared it. That means that S2 is annualized. That means that if one choice for you would be to actually invest in a 2-year money and get 1 plus S2 squared. That is, you will invest for 1 year and then take the forward rate next year. And if the forward rate is observable right now, available right now, then these two must be equal for no arbitrage. That is one of the most important insights, is that 1 plus S2 squared must be equal to, that means that this it must be equal to, if I may write that, and I'm going to just copy this here. This is the, oops, I missed the 2. This is the relationship. And then we don't really need to go through the math. It says S2 is 5%. That means that 2-year rate today must be 5% for the forward rate to be 6%. Notice that the 5% is basically the average of 4 and 6. Now, why am I talking about this here? Because you will need that to actually solve the case. And that's what that spreadsheet does. So if you look at the spreadsheet, and if I did not explain it to you, you would not actually know. But, so coming back to the case again, so the spot rates are given. So we can start by determining the present value of the payments promised by the float pair. The question is, what will the float pair pay? You don't know that yet, because the float pair actually will be exposed to the interest rates next year. He doesn't know. So, so from period to period, he doesn't know. So the second year rate is, or second rate is 2.49%, but he doesn't know that today, because it's a 1-year rate. See, if it were the rate for the whole time, then he will know, but he doesn't know that. These are from this is from 0 to 1, 1 to 2, 2 to 3, 3 to 4, and same at the forward rates. So basically, what it is saying is that you may not know this series, but you know this series. And if you know this series, then you can hedge today by saying that I will be making payments at these rates, 2.91. Now, there is a gap here because the first forward rate and the spot rate are exactly the same. So the number here is 2.06%. Forward rate and spot rate are always at the initiation for the first period. Okay, so it says the present value of the first float payment. So that's 2.06% because that is the rate right now. And then you discount it at 2.06% simply because the rates are the same. You will see that difference next time, because next time you do not know at which rate you will be making the payment. But you can fix that by saying that I'm going to take the forward rate of 2.91% next year. And that way you can hedge the risk related to the uncertainty of the interest rate that you are exposed to. So these are the rates at which you are going to be contracting. And these are the floating rates. Okay. So the next one is this one. Notice the 2.91% because you have already contracted for it. But then you are discounting at 2.49 because you are here and you see that the spot rate has turned out to be 2.49. Now, the question, one of the things that you may wonder is whether these numbers are actually aligned. I did not check that, but it looks a little doubtful to me, but it could be. You should check that. It's basically 2.06 times 2.91. Take the average, it will be, it looks like it should be about 2.49. So that's the relationship between these, which is what I just explained to you. So the next one, so the transaction that the payment that you are making is at the 2.91%. And then once you are making that payment, you know that the spot rate is 2.49. So you take the present value, 14.2. And this is the whole series. So this is the present value of the floating payments that you know today, that this is how it is going to be. Now you need to make sure that the fixed side also will be the same. And that's what this solution is. So you don't know the spread. Now realize that spread here is not the difference between two rates. This is the swap rate. So all you do is switch these floating payments that you see here in this equation by the spread. Now, you can actually do goal seek to solve for this number. I will have to do it by iteration because I'm not very good at goal seek. I'm not very good about it. And the number that works out to be 3.04%. So basically, the swap here is that you will be making fixed payments at or receiving fixed payments at 3.04% and making floating payments at the forward rate, no risk. This is the swap rate or the spread. So, and they have used 3.4 and they have shown what happens with 3.04%. I would do it by iteration. So now the question is, what happens? So let me just go through this once more. That 3.04 is the contract rate. Assuming this interest rates prevail, but in real life they will not. So the question is, then they say, okay, let us see what happens if interest rates go up by 1%. So then they say if the swap is worth exactly the same to both parties, which is what previous example was at 3.04%, it might be puzzling how two traders benefit from entering into the contract. Neither party benefits. That's the way it is priced. The answer lies in the fact that the general level of interest rates and thus the payments made by the float pair, because remember, the float pair is actually exposed to the forward rates, the spread remains fixed at 3.04. It doesn't change. Float pair changes as time goes by, while the spread paid by the fixed pair does not. Table 4 shows what happens to the values of the two sides of the contract if all spot rates increase by 1% the moment right after the contract is signed. The present value, now notice that 3.91, these are numbers. The 3.06, 3.49, 3.82 are 1% above the spot rates from the previous example. And these are the forward rates based on that, 3.91, 4.48. These numbers also are about 1% higher, because if you go back, you will notice that this was 2.91, 3.48, and all of these numbers have been increased by 1%. So this is definitely a simplified example, but it serves the purpose. And so that's what it is. Now, because the payments are going to be made at these rates, remember, forward rate. So the first one remains the same, 3.06, 15.2. This is the 3.04%. And if you take the average, it's pretty close to the 58.1 or 58.8. However, this one is 77.1, because here 3.06, these are the forward, 3.06 is the forward rate. This is the amount of money that you pay. 3.91 divided by 2 times the notional, 19.6. So this is your fluctuating payment, and you would pay a lot more on the floating side, $77 as opposed to 58.8. So yes, either party will gain, no doubt. Absolutely no doubt. And then there is a substantial deviation from the original contract. I will pause to make sure that people follow this example and understand the basic message here. This is not posted because this is included in the Harvard package. Peter, you have a question or do you follow? Peter? All right, I don't know if you can hear me. How about Edward usually participates. So Edward, before I go to anybody else, does this example make sense?
Absolutely.
Okay. Can you summarize in 2 minutes as to exactly what we are trying to do here?
So Professor, this is a question that I asked Professor Jakob again back when he was taking us this concept. You know, say for example, in this swap contract, you know, there is always a party that is benefiting more than the other. You know, so the question is, there is always a possibility. Is there a possibility of a net off, and then the outstanding paid by one of the parties? Say, for example, if I'm having fixed, and then I swap with a floater, and then at the end of the day, if you look between the two rates, there is definitely, in terms of payments, when it comes to the implementation, either the fixed rate or the floater might be on the higher side. So in this case, is it possible for a net off and then the outstanding being paid by the one that is having the beneficiary aspect on the swap?
So what you are saying, you know, in a way, let me just rephrase not exactly your question, but one of the questions that might be asked on this case is the following: that a swap is mainly, and this is a question to the entire class, a swap is basically a risk management strategy. That you have a floating or a fixed, you want to reverse the nature of the cash flow. And the swap, given the current market structure and market rates, the spread solves the swap in a way that neither party gains. But then in the example, if we see that there is deviation, now 1% movement when the rates were at 3% is substantial, as you can understand. That means that a 25% movement either way increase. So there is no question that there will be significant deviation here. But the risk management is definitely defeated. There is no doubt. So how is it that this is really managing the risk? And as I say, 25%, rather the next day, interest rates to go up by 100 basis points is absurd. That simply cannot happen or does not happen. However, that was done to actually show you how extreme the situation can be, that if it doesn't happen on the day after, it can happen in a year. And it will have a huge effect on one of the two parties. Now, going back to the example once more, let me share that. So when the swap was created at 3.04%, right here, neither party actually gained. Okay, one was 58.8, the other one was 58.8 also. at 3.04%. So the question is that when the rates go up, the floating part goes up to $77. So the fixed part, which party is losing here is my real question to you. Which party do you think is losing here? Cliff, you have any insight?
Of course.
Go ahead.
The person who is making the floating payments is going to pay through the nose.
Exactly. So if you are on
gonna
the
cry
floating
like a
side
baby.
making payments, you are going to lose heavily.
Exactly.
So if interest rates go up, then the floating person will be losing. That makes a lot of sense because you
Yeah.
are paying more than you are supposed to.
Exactly. And that's the reason why I asked the question if there is a possibility of a net off.
Of a what?
Net off. Say, for example, now the fixed payer supposed to pay, to the floater X amount, and then the floater supposed to pay the fixed payers X amount. So now, because of the increase in interest rates, the floater is now paying more. So in my question is, can we just say, is there a possibility of say, okay, if I owe you, I'm supposed to pay you 100, and then you're supposed to pay me 120 because of the increase in the interest rate. Can we just say, okay, give me the 20 and we net off?
I mean, in present value terms, you possibly can because all of this calculation is in present value terms. Yes, of course, you can.
Okay.
Yeah, sure.
Yeah.
But again, that possibly where the swaption comes in.
Exactly.
So I'll go back to the class once more. I want to make sure that others are also up to the speed. Let me go to Pitya. I don't know, I'm calling out for people, but they are not responding. I don't know why. Let me go to
I have a
Pitya.
question. Oh, I'm
Okay,
sorry.
hold on. Who is talking?
Leah, I have a
Okay,
question.
go ahead.
So, let's say, hypothetically, if you go from a fixed into a floating, but then a crisis happened, like something like 2008,
Hold on.
because you were expecting
I have
the
I have to ask you a clarifying question. When you
Okay.
when you say you go from fixed to floating, are you
Yes.
paying fixed or receiving fixed?
If you are swapping to and the pay floating to pay a floating.
Okay, so
And
you are paying fixed, you are going to swap to a paying floating. Yes. Okay.
yes, and you were expecting the rates to fall because floating was cheaper, but then like a crisis happens, what would happen in that type of situation?
That's exactly what this example shows. You will end up paying a lot more. That's what I think Cliff was saying.
Okay, just to be sure.
Once again, this is an extreme example, which is supposed to make a point. Peter, I was calling out for you. Peter, you have any questions or comments on this? What do you think of this example? You are mute. I don't know if you can hear me. Can others hear me, please?
You're fine.
Yes, we can hear you. I think he sent a message. He said he's sorry he cannot able to talk.
Okay, all right, fine. That's
Yeah.
fine. Before, how about Malcolm? Malcolm, you have any observations?
Yes, I'm following through.
Okay, you are following through.
Yes,
Okay.
I'm following
Well,
through.
I'll go to Cliff again to make any comments about the case example.
What you can do is you have a bunch of possibilities. What you can do is make a weighted average of what your belief is for the possibility like you may say you have a 1% chance of the rates going up by a full percentage, and maybe you have a 25% chance it goes up by maybe 20 basis points, and that's how you get your weighted probability of what you think it's going to be. That's the next step to this.
Mm-hmm. Well, that's an interesting observation, Cliff. But I will tell you that I believe in the efficiency of the market. And I would imagine that that type of probability the market has already figured into the swap rate.
Okay.
That is not to say that you believe in the market's consensus, because the swap rate reflects the market's consensus.
But if you thought there was going to be a difference from the market, then you could do something like that.
Of course. Yes. No doubt about that. So the takeaway from this is obviously how to solve for the spread. As I say, I did not prepare an Excel for this because I think it is a clear example. And I know that I would not be able to use the GoSeek. I am not very good at that. And I would possibly do it by a couple of iterations, and it would take me time. So, but I'm sure that I could get sufficiently close to the 3.04. So to answer your question, Leah, anytime you are making a fixed payment or a fixed receipt and all that, if interest rates fluctuate, you are always going to be either gaining or losing. There is no doubt about that. So if you think, like, for example, where many people are actually thinking that that mortgage rates are high. I mean, of course, they're higher than they used to be 10 years ago or even 6 or 7 years ago. And we really haven't seen mortgage rates this high in a long period of time. So there is definitely a good reason to consider a floating rate mortgage at this point of time. Sure, that's what many people are doing. But on the other hand, if you are on a fixed rate, then when the interest rates drop, you always have the option to refinance, and some of that I'm sure will happen as and when interest rates drop. That's what many people are waiting for the interest rates to drop, and then they will refinance. But the mortgage is a slightly different example simply because mortgage owners do not swap. However, remember that there are two sides to the mortgage. One is where you are making the payment. The other is the bank that is receiving the payment. They are definitely swapped. They are definitely hedged. There is no doubt about it. Absolutely no doubt about it. So you are possibly not protected. And if you want to protect yourself, the only choice in this high interest rate environment is for you to consider a floating rate. But the bank definitely is. They would not be exposed. So I think this particular case is not that challenging to understand. The Dominion case is a little more challenging, but it is very realistic. So I will go into that one now, and I have already presented a solution for that. So the first paragraph, of course, is the most critical one. It says, Dominion Resources, one of the largest producers and transporters of energy in the United States, was planning the creation of a subsidiary that would consolidate the major components of Dominion's regulated gas businesses under one intermediate company holding company entity. The timeline called for the formation of a new legal entity, Dominion Gas Holdings, around September 2013 by transferring several regulated gas subsidiaries from DRI to Dominion Gas as part of its new financing plan. Dominion Gas planned to issue at least $1 billion, pretty large, in debt on November 2013. The offering would consist of senior notes, and the maturities would be a combination of 3-year, 10-year, and 30-year notes While the coupon rates for the planned date were unknown, as of November 2012, the company wanted to lock in its financing costs ahead of time. Interest rates were at historically low levels, and market commentators were predicting rising interest rates with the end of the US Federal Reserve's monetary quantitative easing looming. The company was considering covering or entering into a number of interest rate swaps to mitigate the interest rate risk associated with the anticipated long-term debt issuance. One particular set of swaps the company was considering was designed as pre-issuance hedge for the portion of the three-year debt offering that assumed a $250 million principal amount of such notes would be issued in November 2013. Then there is a description of Dominion Gas Holdings, which I'm not going to go through. Here is the debt offering, Dominion Gas, November 2013, $1 billion, aggregated between 253 year, 510 year, and 250 million 30 year. Fixed coupon rates to be determined at offer date, interest payable quarterly in arrears on February 1, May, August, November, and commencing on 2014. Optional redemption, that means that they are callable, and ranking. And let's go to the, here is the way forward. In order to manage financing costs and bring clarity to the operational budget and external earnings guidance, wanted to hedge the interest rate risk involved in the debt issuance. For the $250 million of three-year debt it would be offering, the company was trying to determine what fixed rate it could set as of November 12 for a forward. This is the IRS spread they are talking about. Interest rate swap that would start in November 2013 and end in November 2016. In the transaction, would swap floating rate for fixed on a notional principal of $250 million. The proposal would involve Dominion receiving the three-year LIBOR rate and making fixed payments on the same dates as the scheduled payments for the three-year senior notes described. In order to analyze competitive forward rate starting swap rates, again, this is the spread. Dominion had gathered market data. A bank had approached with an indicative quote of 0.70% base for the three-year forward starting swap. This is the spread, 0.7% in November 2013 and ending in November 2016. Dominion wanted to get a sense of this was a fair rate. There are a few other issues to work on. So here is the issue, that they have a 0.7% forward spread right now, or a swap rate. What they don't know is what will be the fixed rate next year. So at this point, I'm going to go to my case analysis, which is a pretty lengthy document. As I say, you may want to have a little time to work on this. So I may go up to 8 o'clock non-stop and stop the class and come back and cover the first hour on this. Here is the basic problem. So plans to issue debt 1 year from now. The company knows it will need financing, but it does not yet know what interest rate it will have to pay when the bond is issued. Here is a term that I've used, which is called X. X actually stands for the fixed rate 1 year from now at which they will be able to issue. That is the unknown. This is the future benchmark market rate. You might think about this as the 3-year T-bond rate. That means that is the base rate. Spread is their risk spread. That means that whatever X is, and at that point of time, X could be the 3-year treasury bond rate plus some spread, and that spread will be determined by the rating of the company. That spread is going to be very easy to get in the market. you can easily get the 3-year spread from the rating itself. What we do not know is the X. So X represents the uncertain future base rate that Dominion will face when it issues the bond. Here is the point. They will issue at X plus spread because that is the rate that will prevail at that time. They have no choice. X will be determined at that point of time. So basically think about X as a, let's say, 3-year treasury bond rate. However, they have a choice. X represents the uncertain future base rate that Dominion will face when it issues the bond. What exactly is X? X is the market benchmark rate. You may think of X as the future 3-year swap rate or base market interest rate. But the more important one is that this is a 3-year swap rate that is possibly available at this point of time. But we'll see to that. Okay? It may not be available right now. It may be available at that time. But the question is that it is going to be fixed, no doubt. But they're not going to get into that right now, but they are going to go to 0.7%. So Dominion's actual bond rate, remember, it will be. They do not know that. They do not know that now. They do not know that. They will know that at 1 year from today. Here is an example. Suppose in November, X is 1.50. November 2013, remember 1 year from today. Spread is 1.20. These are numbers that I've made up. 2.70% will be the coupon rate. They don't know any of it today. They don't know the 1.50. They may have some idea about the spread because they can look at their current rating, and based on that, they will definitely be able to come up with some number of 1.20 or something close to that. 2.70 is the bond coupon rate.
Professor?
Why does, yes.
Are you able to share your screen?
Oh my goodness.
This is a Word document. It's on the website.
Yeah, but I will definitely share. It is posted already.
Oh, okay.
But
Never.
I was thinking.
It's Dominion case analysis.docs.
Yeah. Okay. I actually posted it 2 hours before class because I was preparing for this all day. So you can see it now.
Yes.
Yes.
Okay, good. I'm glad you mentioned that because I assumed that it is on the screen. So 2.70. Remember, none of this is actually known right now. None of it is known. But this is the model that they will follow because they know that 1 year from today, we can find out what these things are. So why does Dominion need the first swap? This is an example that I built with 2 of them. Now, I should tell you that the author did offer some guidance on how this particular case was solved. And there are 3 different ones that he suggested. I have chosen the one that I like most. But these numbers are made up by me. The author did not give me these numbers. The author just basically sort of depicted one possible way that Dominion could have gone. So these numbers are all made up by me, and I use the numbers so that you can follow. So Dominion is worried that X may rise before the bond issue. Suppose today Dominion can lock in a forward rate of 0.7%. So they swap. Actual X is not known. It's the swap rate. Remember, 0.70, which is the equivalent of 3.04. In the previous case, you might wonder, why is this number so low? It is because the interest rate, remember, they mention in the case itself that the interest rate environment at that time was actually historically low. So this is pay fixed 0.7%. They got into that. This is just a swap. There is no bond issue involved here. You have to remember that the bond issue has not happened, but they are entering the swap where they will be paying fixed 0.7% and receive floating LIBOR. This is the first swap. The purpose of this swap is to lock in the future benchmark rate. It protects Dominion if market interest rates rise. So that by November, the benchmark rate has gone to 1.50. Now they will be issuing the bond, okay? Because the bond issue has not happened. Now they are actually going to be issuing the bond at 1.50. So the bond issue is 1.50 plus the spread 1.20, 2.7, 2.70. I've kept the number the same, but Dominion has the swap. It locked in 0.7% when the market rate is now 1.5. The swap gain is approximately 1.50 minus 0.70, 0.80. So the swap offers 0.80 higher borrowing cost. Dominion's effective cost becomes 1.90. So they are actually gaining by about 80 basis points. So basically, what is going on here is that they are receiving the 0.70 but paying the 1.50. So so the hedge converts the uncertain future cost X to 0.70 plus spread. I think the numbers look plausible to me. Remember, the spread that they are first swap they're entering is in November 2013. You need to think about this a little bit. Make sense? Since this is already posted, I presume that people already have access to it. I will of course share once more, but the question is the mechanics clear?
It's straightforward. They're fixing their costs now rather than guessing what the market's going to do. Well, they're hoping that the market won't go up. And that's what they're protecting against.
Mm-hmm. The example that I built there includes another swap, and you will see how nicely it actually works out. I'll get to that swap later. But the real issue here is that 0.70% spread was available, which is what they took. But they're not issuing the bond right now. The bond issue will actually be at a different, have to be at a different rate simply because the rates are different at that time.
But they'll make extra money on the swap now that will help compensate them.
Yes.
For what they'll have to pay later on if the rates go up.
Mm-hmm. Now you might actually think about this in the following way. That let me go back. That and I say that there is a second swap involved here, and I'll get to that possibly after the break. The point here is that this this is actually they are issuing the bond. This is not a swap. The bond issue is actually at this rate because that is the prevailing rate at that time in the market. So this is the actual bond issue. And that X is market determined. They have no control over that. What they have control over is the swap rate today, which is 0.70. And clearly, 1.50 is much higher because interest rates have gone up, which is exactly what they were trying to hedge. So you will see that this unknown part, the X actually can be reversed by creating another swap at that point of time, which I'll get to in a second. But I think that they don't actually need a second swap. There is no doubt about that. They can definitely stay with this, the first swap that they did. There will be some difference because there is what this has not been adjusted for is the LIBOR rate, which I will get to. This has not been adjusted for simply because there is a second swap which will reverse that transaction. But the point here is that there is as Cliff correctly pointed out, that there is a definite saving here. And that 0.70 really is saving what you really will pay.
This is the situation where they knew they were going to have to pay something in 3 years, and this is the way they just minimize what they were going to have to pay.
Yes. Again, remember the numbers are a little extreme. Why? Because I have assumed that from 1 year it will go from 0.70 to 1.5. That's a drastic increase, but
But 3 or 5 years ago,
yes, could be. Yes, that is true.
during COVID.
Yes. I mean, in fact, during COVID, I thought I did very well, but then I found out that my friends have done even better. I did actually an addition to my home, and I took a 15-year at 2.375%. That was about, I would say, 4 years ago. Right now, I don't know the exact rate, but I'm sure the 15-year rate is at least 4.5 to 5.
Probably closer to 6.
Exactly. So these numbers may look drastic, but as we pointed out, yes, that can happen. That rates can more than double. So there are a lot of people, including my wife, who is very, very risk averse and says, you should pay off this loan. I don't want a mortgage on my house at this point of time in my life. I said, there is no way I'm going to pay it off. Absolutely not. If somebody gives me that money at 2.375 right now, I'll jump to it. Absolutely jump to it. Simply because think of the arbitrage. Think of the arbitrage that if I had actually spent my own money rather than borrowing, the borrowing, and then let's say that I did actually have that money, which I didn't, but I had a little bit of it at least, which I actually invested in the market, and think of the arbitrage I made. It is enormous. Think of how the market has performed over the last 3 or 4 years since COVID. And the arbitrage is very, very clear. So can I pay it off now? Of course, but I'm not going to.
Then you could deduct the interest off your income.
Exactly.
You make even more money.
Mm-hmm.
That's why people. That's why nobody can move right now, because all the people who have houses have 3% mortgages, and they're not going to sell their house to pay a 6% mortgage.
That's exactly right. That's why the house market is so slow, that they do not want to sell the house because they will be forced to get into a mortgage which is at a much higher price.
That's just 3% to 6% interest cuts in half the amount of house you can afford, or to do a 30-year mortgage.
Exactly. So, okay, folks, I am going to allow the class a little time to come back and absorb it. It's about 7:35 now. Let us take a break. As I said, I'm not going to finish this full I will finish this example because there are spreadsheets that I want to show you. But this particular case analysis, I will be happy to go over once more after you have had time to look at it in full and come back with and understand and ask me any questions on the mechanics. But after the break, I will show you the second swap as to how nicely it works, and also share a spreadsheet, which I have already posted, which also shows how you can actually price a swap. So that it's a little more complicated than the example in the book, but it is related to the numbers in the case. So let's take it's 7:35 by my laptop. We'll come back at 7:50. I will walk you through this case or the case analysis, and then spend time with the spreadsheet, and that will be all for the day. I will come back and revise all this again tomorrow. So let me pause the recorder. Of course, after the break, I'll be happy to take more questions, but I think you need a little time to read the case and think about this before you ask, ready to ask questions. So I'll pause it. All right, folks, I'm back. Just making sure that you can hear me.
Yep.
We can hear you.
Good. Well, I seem to have lost 2 students over the break, but it's okay. So I'll go into the second swap now, and then there is a spreadsheet that I have posted, which I'll go through in detail. So coming back to that example once more, and let me share.
Do you want me to make you a spreadsheet for like what you said you did the gold seek on, but I use Solver, but
hold on for a second. Can you repeat that?
do you want me to make you a spreadsheet that uses Solver for the thing you said you iterated through the?
That will be great.
Okay.
I mean, I may not share it today, but I will definitely share it tomorrow.
Okay, I'll make it tonight.
Yeah, because I assumed I mean, I did through iterations and all, so it is pretty precise. But if you can do it by GoSeek, that will help the class a lot, and then you can repost it. Just do it on my own spreadsheet. So going to the second swap here. Why does Dominion need the second swap? And you will see the cash flows work out very, very nicely. Strictly speaking, does not need, but it will help. The second swap is used to close out or unwind the first swap so that there is no LIBOR issue and all that when the bond is enter a second offsetting swap, cash settle, or you can do cash settle, which I actually have shown, but the class will need a little more time to understand it, and I'm not going to go through that in class today. That's where I will start next tomorrow. That means the cash settlement I will start tomorrow. I will not actually go through that in class today because there are some numbers and examples that the class has to review. So the first swap was pay fixed 0.70 and receive LIBOR. The second swap, and now we know the swap rate. So the market swap rate is 1.50. So you receive fixed 1.50 because this was pay, here you receive, and pay LIBOR, exactly the opposite. So the first swap is pay fixed 0.70, receive LIBOR. And second one is receive fixed 1.50 and pay LIBOR. So LIBOR will cancel. And what remains is 1.50 you receive minus 0.80 is the negative, is the positive. And for the life of the swap, that is exactly the value of having locked in a below market fixed rate. So it works very, very nicely. So, and then there is a cash settle, which I'm not going to get into. And I also prepared a sort of like a diagram which shows the transaction. And for some reason, and it was, I had to sort of scan it and email it to me, but the scanning did not work. So I'm going to recreate that into a PowerPoint slide and post it overnight so that you can take a look at the actual transactions. So there are 3 things involved here: 2 opposing swaps and 1 bond issue. Now, I want to go back to the top of this diagram case again, that remember the bond issue actually is taking place at rates that are known 1 period from now. And that is X. That means that this bond issue is happening at 1 period from now, at 1.50. But at time period 1, they had already entered a swap when the swap rate was 0.70. So there is a big advantage to that, and that's what this particular case highlights. Once again, the interest rates are widely different here. However, they don't really need to be. The mechanism of the whole thing, the mechanics of the whole thing is important. I will more tomorrow. The class should come back with any questions, because you can definitely expect it is difficult to get real life examples of swaps. I'll tell you why. Because these are not transactions that are actually always in the public. These are transactions that are, and because, these are very big financial institutions and very large companies involved here. So the transactions of this are not really very public. I do not have, and these are not reported, so I don't really have access to this, but I am trying to get one through one of my friends if I can. But the exam will definitely look very similar. Exam question will definitely look very similar to the Dominion case, that it will involve some kind of a financial transaction, which the company is actually trying to sort of interest rate manage through a swap. And the next example that we will be going to is to calculate the swap rate. And that is something that, as I told you, that there was an example in the previous case. This is a little more involved. And let me open that now. And this is called the DR spreadsheet. So this is also posted, so you should be able to see it, not that one. Let me see. Let me see. Hello.
We could see it. It's on. I've got it open.
You have?
Yeah. DR spreadsheet at XLSX.
Yeah.
Yeah, we could see it. It's on this Husky CT.
For a second, let me check.
Shows up as 2 pages.
Here is the thing that I think is most important. These are yields that are given. The settlement prices, these are forward contracts. And the first thing that you really need to do is to actually take a look at how this has been calculated. So 0.44 is actually 1 minus this. These are all settlement prices of futures contracts. Remember, these are observable right now. Okay, so 99.56, 1 minus that is the yield. Then based on that are the spot rates. Now, these are the spot rates that have been calculated using the formula that I shared with you before. Okay, so this particular one, this is calculated straight from the settlement price. So this is very easy to calculate. These are the ones where I have used the formulas. Now, remember that the contract will be made on these rates. Okay, so the first one is $250 million. And this is the number that actually is something that, so there is a 4-year swap, 3-year swap, and 3-year forward swap. So this is the number that can be actually solved, and you will see that it will work exactly. But I have taken that number actually. So a 3-year swap, first floating leg hedged cash flow. So this number here is C5. C5 is 0.44. That is the yield divided by 4. So this is times K1 is the $250 million. So here is the floating rate. Basically, these are the ones that you actually are going to be. This is basically the swap is right here, and these are the ones that you will actually be exposed to. That means that you can make a contract right now at these rates. to make these payments. So the first one is the floating rate payment that you are making. And this is the fixed rate at 0.50. And this has been solved because the thing is that you calculate this and then take the present value. Why do you need the spot rate? Because the present value has been calculated at the spot rate. So you will see that in order to calculate this present value, I have used the spot rates. Now, the spot rates must be used because those are the rates that actually prevail. So let me explain once more that these are the yields that you can actually make a contract right now, that I will be making a payment or receiving a payment at this rate. Okay, so the swap is basically make or receive payments at this rate. This is known.
Professor,
And yeah,
you aren't sharing.
I'm not sharing.
No.
That is strange. Sorry.
I was following you because I have it open, but
That's
we
okay,
can't see
but
it.
I will
But
share.
if you're pointing,
It is easier to share and show. Yes. So let me go through this once more. This is observed. I will show you what is observed. This is observed. So as soon as this is observed, you know these rates. Okay. And you can actually, it may look very small, but these are sort of 1 year forward rates. And these are the settlement prices of the futures or forward contracts. And these are the yields. Okay. Now, the question is that how do I know the spot rates? You don't know the spot rates simply because the spot rates will be available later on. But based on these, you can, that if this particular column prevails, then you can actually assume and calculate the spot rates. So this particular spot rate, each of them has been calculated by using the formula that I shared with you very first in the class. That remember that 1 plus S2 squared equal to 1 plus S1 times 1 plus F2. That is the formula that has been used here. So this is the one at which the payments will be made or received, variable one. And the question is that once you calculate the present value of this at the spot rates, you know this is $3.7 million of payments that have been made. You immediately make this number and this number equal. Once these two numbers are equal, you know that you want to be equal because this is the fixed side of the swap. The question is, what is this number? And that can be done by the goal seek, because once you know this one, because this is the only number that has to be assumed, then once you assume the 0.50, each of these can be calculated. That means that this is equal to L2. L2 is this number, 0.50, the rate, times K1, which is the $250 million, and this can be calculated. Notice that they are all equal. And then you take the present value at the spot rate. This is calculated, so I'm going to put this in a slightly different color so that you know that this is calculated. This is the only one that has actually been calculated. Everything else follows from the. So this column F has been calculated based on column C using the no arbitrage relationship between the fixed rate and the spot rate. So I'm sure there is a question of what can you expect in the exam. You will be given these settlement prices, and from the settlement prices, you will be able to calculate the yields. Okay, these are all annualized, remember. Okay, however, these payments are actually not annualized. Notice that they are actually 3 months, which is why you will see that there is a divided by 4 right here. Because these are quarterly payments, this is divided by 4. So that's what this is. So once you know this rate, the yield, you can calculate this. So this refers to the YOLO. 3 years, so this refers to the YOLO one, but is the one that has been calculated. Basically, the solution. So the 0.50 or 50 basis points is the swap rate. When you are doing it, it will, if you know how to go seek, use the go seek, then it should not be a problem. However, for me, it is a problem because I don't know how to use that. So it takes me a few iteration. But I mean, as an instructor, I have access to this number. That 0.50 is basically what is going to solve it. So I basically took that. But you will not have that privilege. So you will be given this column. You will be given column B. You will be given the L2 number, based on which you will be able to calculate this column here. You will have to calculate this column spot rate and the present value. So the target number for you is this number. And then once you have that target number, you will have to go seek this number, which will create a fixed column for you of payments, and that is the whole swap. So in real life, people can get pretty close to this, because as soon as you know the C or the B, you can create column F. There is no doubt about that. However, the problem that you will have in real life is that everything here is going to change. And that will change each of these numbers. This one is unlikely to change because this is the fixed. So the change will happen right here in column K. And the difference between the two is either a gain or a loss to either party. I will definitely go through this in more detail again tomorrow, because I think it can be complicated for some of you, but maybe not for all of you. I can take questions at this point, because as I said, I will allow time because the case can be complicated. So you really should take time and review this. And I will possibly give you half an hour more tomorrow because I'm finishing up sooner today. But are there any questions? Let me ask the class a couple of questions as to how you really should be thinking about it. One question that you should be thinking about, and I will start with that tomorrow, is in the Dominion case, is the second swap necessary?
No.
Okay, then you will explain why.
They've already made money in the first swap. That's locked in.
Okay, but others do not have to agree with him, or if you do not agree with him or disagree with him, then you really need to think about why. Another way that you can think about it, Cliff, is does the second one help any?
Oh, you can always make
there is transaction cost, although these are highly
you can always
liquid
make more money,
instruments,
but you risk losing money.
Huh?
You can always make more money with the second swap, but you also risk
Yes.
losing money.
Yes.
So you don't have to do it, but you can do it.
Yes. So the question is that if you do not have to do it, then if they did, why did they? And what happens if you do not actually do the second swap? So that is a question that I will definitely be asking you tomorrow. Another question that I will be asking you tomorrow is whether you understand that cash settlement one, and how does that work? Because these are the types of questions that you can expect, and of course the pricing. So that there are three different ways that the question can be set. One is obviously what is the swap and what are the different advantages of swap. It is called a risk management tool. It is a risk management tool, but as you see that in real life, one of the parties will actually lose because it is priced in a way such that it is at the initiation, neither party makes any profit. So in real life, that is not going to be the case. Then what is the real advantage of a swap? That's one of the questions. That if there is a discrepancy between the interest rates, which is bound to happen, now maybe not as extreme as the example in the cases, but it is bound to happen, then what is the real advantage? That's one of the questions. The other question is, as I said, is the second swap necessary here? And if not, then what is the transaction for the first one? How, which party is making money or which party is gaining? Now, in this particular case, it is very easy to tell because the interest rates went up. So the party that is making fixed payments are going to be actually a lot of better off, no doubt. And the last question that we will talk about is, as I mentioned, as to whether there are any questions in the spreadsheet. Now, people get misled in the spreadsheet. Here is why. That forward rates are actually extracted from the spot rates, okay? That means that at any given point of time, you can observe, just like, let's say, if you are asked, what is the 1 year spot rate? You will say, okay, let's look at the 1 year treasury bond or 1 year treasury bill, fine. If you are asked what is the 2 year spot rate, you will say, okay, let me take a look at 2 year spot rate for a treasury bond. These are not 1 year or 2 year rates. The first one is a 1 year rate. All of these spot rates are 1 year rates starting 1 year, 2 years from now. That is different from the spot rates that are available at this point of time. So you have to be very careful to understand that the spot rates we are using here are slightly different. Okay. So I will possibly stop here. It's about 8:15, and start with the case once more. I hope that everybody will be reviewing the case and read the case and the solution also, and come back with comments and reactions, and then we will talk about that. And of course, I will talk about the portfolio theory, portfolio construction case also, which is very, very straightforward. It's not really a portfolio construction case. It is a question of selection of certain securities and what are the criteria. That means that what are criteria that analysts use to select securities. Obviously, the return is one of them. The other more important one is risk. So it's a very straightforward case, but based on real life numbers for a student fund at the University of Virginia, which is why this case is so widely used all over the country. Wherever there are student funds, they use this case, but this is not a portfolio construction case. Remember, this is a question of how to select securities that will be going into the portfolio. What are the different characteristics that you look for, and how do you trade off risk and return? What are the different measures? So that's the main focus of the case. So there will be questions on the portfolio case also, but not very involved. Okay, folks, I will stop the recorder at this point. I am definitely going half an hour early. I will allow the next extra half an hour tomorrow with respect to all the questions that you may have on the exam. That this case will be discussed in more detail, as well as the portfolio case. So the portfolio case is very short. I hope that you will have time to review it, because that will possibly be the bulk of the time in the second half. The first half, the first hour will still be the interest rate swap. Okay. Thank you very much. Are there any questions? Anybody?
So like the question you are talking about, if it is necessary for the second swap. So the first one has to deal with the debts.
Yeah.
And the second one is the swaps.
Well, that's a very good observation, that the first one is essential because it is the real one that is exposure.
Yeah.
But the second one is basically a reversal,
Yeah.
where you are reversing the cash flows. The question is it really necessary? And now Cliff says it is not, but I want more opinion from the class. So the two swaps have two different purposes. One is almost the flip side of the first one. The second one is almost the flip side, which is sort of matching the cash flows so that they cancel. And I will, as I said, I have a diagram, which I don't know why the scanner did not send it to my, you will see in the diagram how the cash flows. Remember, the best way to look at it is there are three transactions here. Look at the cash flows for the bond. Look at the cash flows for the first swap. Look at the cash flows for the second swap, and you will see how nicely they cancel. If you look at it that way, then you will see why the second one, what purpose is the first one serving, what purpose is the second one serving. The best way to understand it is to actually do the cash flows. Put down, I will show you the diagram tomorrow. I will work on it tonight, and because the scanner didn't work, I will put it on a PowerPoint spreadsheet, a PowerPoint. So put Dominion on the left. Then on the right, you have three entities. One is the bond. The second is the first swap. The third is the second swap. What are the cash flows involved with each? And you will see how nicely they cancel and what is the net effect. Does that answer your question, Edward?
So it's okay.
That's the best way to understand it.
Yeah, thank you.
There is a purpose to the second one. The real question is that essential?
Okay.
Any other question, folks? All right. We will start at 6, and I will see you tomorrow at 6 o'clock, last class. But there will be a review session. By that time, I hope that I will be able to set the test. But there could be time tomorrow also for the exam. So good night, and I will see you at 6 o'clock tomorrow.
Thank
Thank you.
you.
Thank you.
Pleasure.
Bye.